love the channel and find it useful in becoming a happy retiree. Subscribe today. We're headed to Cobb County with Don on the line. Don, what's going on? How can I help?
Hi. I'm just curious about how far away from an index fund should a managed fund be, so I wouldn't consider it a closet or a shadow fund.
So again, what Don is a really important question. It goes back to active versus passive investing. The problem, one of the big problems why mutual fund managers are active mutual fund managers have gotten a bad reputation, a bad rap, is that a lot of them get to the point where they've got these billion-dollar funds and they just don't want to get fired. So they play more not to lose than to win. And in order to do that, what a lot of these mutual fund managers will do is that they'll construct their portfolio that looks not exactly like the S&P 500, but pretty darn close. So that they're never ever and again, you count in their fees, let's say, you never are really above the S&P, but you're never a whole lot below it. And you're paying 1 or 1.5% a year for what Don's asking about, which is, hey, is it a closet index fund replication? And that happens to a lot of funds.
Right. If you compare them, using something like Schwab fund comparison charts, the charts over 10 years are remarkably similar.
If you go to Google, Finance or Yahoo Finance or any big charts or wherever you want to chart anything, and you overlay your mutual fund with the S&P 500, and they look like twins, or if they look very similar, or they're cousins, then you've basically got a closet index fund. And that's how you know you're paying a big fee for a fund that's really adding no value. The mutual funds that have over time outperformed the S&P 500, they don't necessarily do it every year, Don.
Right.
But over, let's say, a 5-year period, that's when you can see results that really work, which leads me to one of the things that I wanted to talk about today anyway. So Don, thank you for your call. One of the thoughts I have today here goes back to this question of active versus passive investing. There was a really interesting article written by a fellow by the name of Jim Cullen that I want to reference here today. And this goes back to what I had originally talked about, where there's almost fake or false news in the investment industry. The more evident, and it's more evident than ever, if you hear something over and over and over, even if it's false, at some point you end up believing it. And that's the real issue in this active passive debate, because you've heard this drumbeat of, all active funds underperform passive. And that's just really not the case. There's a significant bias in these studies, and guess who's coming out with these studies? Well, companies like one of the main studies that gets cited in the Wall Street Journal is a company citing that passive funds beat active funds, and guess what they do for a living? Well, they sell passive funds. So you've got to understand where the news is coming from. And there's a fellow by the name of Jim Cullen who I've read about, and you'll find him in Barron's throughout the years, and he's been interviewed many, many times, and he's run several different mutual funds for many, many years. And he reminded me of something that I've mentioned here on Money Matters over and over again. It has to do with Warren Buffett and the active-passive debate that Warren Buffett weighs in on. First of all, Buffett, remember, he's known for active investing. He's picked winners. He's held on to those winners, and his fund has made thousands and thousands of people multimillionaires just by investing in his fund, Berkshire Hathaway, which is very much an active company trying to find companies that are doing better than the rest of the market. So it's through his stock picking that he's made thousands of people multimillionaires. Yet Buffett says that most investors should just buy the index, like the S&P 500, which is kind of ironic, isn't it? So it's to me, it's odd that his advice is so counter to the way he actually operates and how he was taught. His mentor, which I've written about, Benjamin Graham, wrote about it in my book. I've written articles about this. was his professor and his mentor. And Benjamin Graham used basically three very straightforward investing principles. He looks at price to earnings ratio, PE ratios, price to book ratios. So the price of the stock relative to really what the all fundamentals of the company would really be worth. So that's a way to look at price to book. And then dividend yield. And Benjamin Graham wanted to see some sort of reasonable dividend yield from a company. And you put those three together and you found stocks of, quote, good value. And he also preached holding stocks for at least a 5-year period because there's a lot of noise in 1 month, 3 months, 1 year, even 3 years. But over 5 years, stocks eventually find their fair value. So let's look at some of the results of the S&P 500, just the index, versus owning only the bottom 20% of stocks on a price to earnings basis, mainly looking at relatively inexpensive stocks, so not paying a lot for those earnings. The bottom 20% of companies when it comes to what you have to pay from an earnings perspective. So think of this as the 20% of companies in the S&P 500 that are effectively on sale. And the methodology here is you hold that basket for 5 years, then you hold a new basket for 5 years. And you do this all the way from 1968 until the year 2012. That's a 45-year period of time. So again, only owning the bottom 20% by PE, 5 years, then you switch to a new set of the cheapest 20% of stocks by price to earnings. Interesting. You look at each 5-year period, whether it's 68 to 72 or 1973 to 77 or 78 to 82, 08 to 2012, the grouping of the lowest 20% of PE based on price to earnings won versus the S&P 500 every single period. So during that span, the S&P 500 index averaged a very respectable, and you've heard this number before, 9.5%. That's a great number year after year. That's an average annual rate of return. So $100,000 turned into $5.9 million. That's a big deal. But the value approach, and this is a study that you'll see from Jim Cullen, the value approach averaged 15%, actually 15.1 to be exact. How big of a difference does that make in terms of dollars over time? Again, $100,000 in the S&P 500 turned into $5.9 million. $100,000 in an approach that ended up compounding at 15.1% over time. $100,000 turned into $57 million. Basically 10x. That's a 10x return over what the market has done. So yes, you've got serious downturns in all those 5-year periods. You've got a minus 19, a minus 46, a minus 34. So it's emotion that beats most investors, not the fact that they choose active versus passive, because the numbers are very clear. With the right strategy, an active or thoughtful, even a thoughtful approach to investing can absolutely surpass one that is passive. The results are clear as day. The question remains, can you handle that emotional strain or the emotional roller coaster? That's the real variable that humans and investors need to control. Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.